Hello, everyone. I'm here with Eric Kuby of North Star. How are you, Eric, today?
I'm very fine. Thank you for asking, Kevin.
Yeah, and you're out in California. You're placed in California and avoiding all of this cold and snow. That's why there's a smile on your face, huh?
Yeah, it's for what it's worth, it's 75 and sunny here, so that's
Yeah, yeah. Well,
quite
I can
different
tell
from
you.
when I left Chicago.
Yeah, it's not 75 and sunny in Chicago today. So last year, the small cap portfolio that you ran for us was up between 17 and 18%, which we consider to be a great victory. And as you and I have talked about, if we had projected that at the beginning of the year, I think we would have been checking each other's temperatures. But it was really very, very good performance.
Yeah, we were really happy with the way the year went. Certainly, again, if you had told us everything that was going to happen during the year, including the huge surge in inflation and the pandemic, and then you said, well, what's the market going to do? We would have been thrilled with 10%, which is kind of what our long-term goal is. And so this was a much better year than we expected or would seem to have been rational based on what happened in the world.
Right. Yeah. So tell us a little bit about the portfolio. What's your view on it? Overvalued, fairly valued? It still has a very, very attractive dividend yield of 3.75%.
And we feel really good about where the portfolio is right now. We try to chart the securities in the portfolio versus what we view as our expected value, kind of using a traditional discount cash flow analysis. And actually, the gap to expected value is quite large right now. So we think that the shares remain, in general, quite undervalued. Now, there's winners and losers, as always. Some
Sure.
of them seem expensive, and some of them seem very inexpensive. So it's a little bit of a mixture. But as a whole, we're looking at a portfolio that's trading at a discount price to book, discount price to earnings, discount price to sales, discount EV to EBITDA than the general market with we think better growth characteristics.
Yeah. And you focus a lot on cash flow, and you're really enamored with the cash flow of the portfolio right now.
Yeah. Yeah, we think that that we believe in getting paid. We like to get when we're shareholders in companies. We like to sense that we're getting a return, an actual return besides just the appreciation. And in order for a company to return capital to shareholders, they need to actually have positive cash flow. So we
Right.
focus first and foremost on the positive cash flow.
Right. Right. What are the things that you're seeing that you think are bargains today?
Yeah, well, I mean, I think that some of the stocks that are on the low end, these are the ones that haven't performed last year, strike us as being particularly interesting right now. Um, One company that we just added to the portfolio, Escalade, which is a sporting goods company, we think is extremely attractive. They dominate all these niches like pickleball and ping pong, billiards. They just made an acquisition of Brunswick's billiards business. I
Hmm.
mean, and again, the stock is trading at a single digit multiple with almost a 4% dividend yield and a great balance sheet. And
Right.
we just think a really terrific management team. So that's one we just added to the portfolio that we feel is particularly inexpensive.
Right. So uh, a six multiple and a 4% dividend yield was something that think people thought about at the lows in the 70s. Not right now, but you're able to put together portfolios that are very reasonably priced and have very attractive dividends, and not just attractive dividends, but you've had really attractive growth of those dividends, and you see that continuing.
We do, and again, I can give you a little credit on this, Kevin, because I know when we first started talking, you were very influential in talking about dividend growth in addition just to dividend yield, and we always thought that was important, but I think we doubled down on that the last few years and really focused on the companies that have these long histories of dividend growth, and we do find that you get extra performance along those ways, and companies that are dedicated to growing their dividends, I think typically are very good to their shareholders. So that
Yeah.
has been a key for us.
Yeah, and small cap has underperformed large cap. It just seems to us that as we think about where is return going to come from as we look forward, We think small cap's going to be very attractive. In fact, we're very likely as we get into this year to be increasing our allocation to small cap and decreasing the allocation to domestic large cap.
Yeah. Well, small caps have massively underperformed for the last 5 years, which creates a huge valuation gap, versus their large cap brethren. So we think they're great bargains. In fact, the small caps kind of topped out in March of 2021 and then went sideways for 8 months before finally making a new high, and then immediately dropped 10% as soon as they made a new high.
Right.
But again, we look at a lot of these companies and they are trading at single digit multiples. They're really good businesses with great balance sheets. So we think they're great bargains there.
Right. The world's become very enamored with a lot of these companies that are great companies. Amazon, we used to go to stores. We don't go to stores anymore.
Right.
We just go to the web and order everything on Amazon. In fact, I just needed a pair of shoelaces, and I got them delivered the next day, and I think they were $3. So it's a great service.
Yeah.
But you do wonder about the price. Is that price sustainable? How do you see it?
Well, I mean, it's sustainable under one scenario. The scenario is that interest rates stay near zero forever.
Yeah.
And we've talked at great length in the past about how, the type of stocks we like, the type of companies we like are being valued on what they're earning today, their actual cash flow.
Right.
And companies like Amazon or Microsoft, Google, great companies, Apple. I mean, again, if you're looking out for what they might earn 20 years from now and then discounting them back at 2 or 3%,
right,
you come up with huge valuations.
Yes.
If interest rates went normalized, and you were discounting them back at 6 or 7%, they're wildly overvalued.
They're wildly overvalued. Yeah. And that's our fear. We kind of feel like we've seen this movie before in the decade of the zeros after the S&P was overvalued in 1999, the first quarter of 2000. It actually had slightly negative returns. And that's what Rob Arnott is suggesting right now. Is your expected return from domestic large cap growth stocks is flattened down slightly. And so we think domestic small cap and international and emerging markets will be the places where you'll get return. We also think that there will be this shift. I do think all of these companies are great companies, but at some point in time, they have to be fairly valued, and then they look way overvalued to us.
Right. I mean, as a story we like to tell a lot, Microsoft was a great company in 1999. You would have lost 70% of your money over the next, several years, and Microsoft had taken 15 years to get even if you had bought Microsoft then. So it was always a great company. It's just, what price are you paying?
Yeah, right. And, we remind clients from time to time that what we're doing is to try to make good investments for them. Not that we're buying bad companies. It's just that the greatest companies trading at overpriced stocks are still overpriced stocks.
That's our belief as well. Absolutely.
Yeah. Well, Eric, thank you very much for the update. We appreciate this. We appreciate everything you're doing. We think, as we talk later this year and next year, we're gonna be very glad that we have the dividends and the growth of dividends that we have from you. So on behalf of all our clients, thank you.
Well, thank you, Kevin. We appreciate it. And I think one thing we know for sure, 2022 is going to be an interesting year, one way or another.
It is certainly going to be that.
Right.
So stay tuned.
Okay.
Nice to see you.
All right. Thanks.